Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm speaking to you on this January 3, 2017. This is the first business day of 2017. I'm happy that you are with me, and so that I can take this opportunity to wish you all a happy, healthy, peaceful, and prosperous new year. I do like to remind you each and every week that I am also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And you can subscribe to my letter by going to miningstocks.com, or you can call our office during normal work hours here in New York, and that number is 718-457-1426, 718-457-1426. Regarding Chen Lin, I need to tell you that my company, Taylor Hard Money Advisors, is no longer providing subscription fulfillment services for Chen. So to sign up for Chen's letter, you need to go to chenpicks.com. That's Chen, Picks.com. Chen and I will remain friends and informal partners. We will continue to share investment ideas with each other, and Chen will appear on this radio show from time to time. Well, I have the highest regards for Chen, his intellect, his work ethic, his honesty. He has been a wonderful friend and partner, and I hope to an extent listeners from this show can benefit from his insights from time to time. Of course, to benefit fully from Chen, you do need to go to his to sign up for his letter, chenpicks.com. Chenpicks.com is where you need to go to sign up for Chen. I want to thank each of you for listening to this show, and I want to encourage you to continue sending along your questions, comments, criticisms, and praises to questionsfortaylor@gmail.com, questions, the number 4, taylor@gmail.com, and would also like to invite you to follow me on Twitter. My handle there is jtaylormedia. We do want to thank our sponsors for making this show economically viable. Our sponsors for today's show are Dynacert, RN Resources, and Novo Resources. And Dynacert, in fact, the CEO for Dynacert will be with me. Jim Payne will be with me in a little while to talk about that company's technology, which is reducing fuel consumption in trucks primarily right now, in major large-scale vehicles, reducing the fuel consumption by up to 20% and reducing carbon emissions as well. So it's a story, I think, that has great potential, and we'll look forward to talking to Jim Payne very shortly after the first commercial break. I've titled today's show Market Outlook for 2017. And Alistair McLeod will be with me at half past the hour. Michael Oliver is with me right now, and we'll hear from him in just a brief moment or two. And Jim Payne, as I mentioned, the president and CEO of Dynacert, will be with me after the first commercial break. With optimism surrounding Trump's election, stocks have made new highs, with the Dow nearing 20,000. But once the Trump honeymoon is over and reality sets in, what will be the direction for stocks, bonds, commodities, and currency markets then? As debt grows exponentially compared to a linear growth of income, if income is growing at all, I might add, something has to give. Now, some analysts suggest that no matter how much money is printed, that we are heading for another 1930s-style deflationary economy, because the massive debt will simply overwhelm any new money creation. I'd say that Dan Oliver is one of those that might think along those lines. We've had a few other people from time to time on this show as well. Others, like John Williams, who's been on this show, see a dollar collapse from some loss of confidence in the Fed or in the dollar, basic U.S. dollar hegemony. They see that as leading to a major inflationary problem. And, we're going to hear what Alistair McLeod thinks, which of those directions he may be leaning and what he thinks might be in store for us in the major markets during 2017. As I said, one bright story that I see, though, is the Dynacert story. And there they are reducing, as I mentioned, fuel consumption for trucks up to 20%. Now, if we are in a bull market for energy and other fuels and commodities in general, then I would think fuel consumption would certainly be something that people are going to pay more attention to. But we'll hear what Jim Payne has to say after the first commercial break. But right now, I'm really pleased to tell you that Michael Oliver is with me, and thanks for joining me again, Michael.
Great to be back, Jay.
Always good to talk to you. Early last year and even late into 2015, as I recall, your momentum work began to point to some secular changes in major markets, and indeed to a great extent, they have come to pass. For example, you predicted that commodities would start a new bull market led by precious metals, and right on the mark you were last year, Michael. That certainly has turned out to be true. Gold led the way, and then we started seeing other commodities rise considerably last year as well. You predicted that major sovereign debt markets would also start to run into some trouble and start a long bear market, and that also seems to be panning out with T-bonds cracking through some key levels, and on the downside, the Bund and the Japanese bonds and so forth. I think you've also mentioned, probably with a lot of emphasis, the Italian debt markets as well. At this point, however, the other two major tectonic plates that you talked about, namely stocks and the dollar, have not yet seemingly they haven't yet turned negative. So my question to you is, how are things looking to you at this point as we start 2017 for those major markets that you talk to us about so frequently?
Well, I suspect when you go back, let's say the end of this coming year, and you look back over the last 2 years, 2016 and 17, you're going to see that in 16, the first two categories did make their shift. But remember, the T-bonds only broke down, according to our metrics, in October, so it's late 2016. And by breakdown, I mean in price, therefore yields rise. Gold was a leader on the upside in February, exploded, pulled back sharply to a level that we regard as key support, and so far it's held it. Within, literally, I defined a number where I was going to go neutral, and it stopped $4.40 in front of it. So, and now since we bounced quite sharply. But I do think that the commodity upturn is underway. It's measurable, and it's not just gold, silver, and oil. There's some other markets as well. I think the grains will engage next year, even the meats. So it'll be a broad turn. But the other two markets that are most deceptive, you have to realize that they really aren't going anywhere meaningfully for an investor or for a pension fund or anything of the sort. Stock market. Again, U.S. stocks are up, but relative to other developed markets, stock indices, they're like in a different universe. The S&P has marginally climbed since late 2014, a couple percent here, a couple percent there, such that it's up about 6-7% above the highs of 2014. Now, that's 24 months, and you're fighting over percentages. You could have a bad day and wipe it out.
Right.
So the real bull market in the S&P was between late 2011 and late 2014. After that, it basically was sputtering, holding and making new highs, but sputtering. The same is true with the dollar. The dollar peaked in early 2015, dollar index I'm speaking of. It hit a target that we had. We were bullish on the dollar from 2012 onward. We expected to see 100 on the index. It hit 100 in early 2015, and then sputtered sideways for a year and a half, 2 years. Recent upside action has taken out that high by all of about 2% or 3%. Right now it's at 102 area. So 2 years later, the dollar's up 2%, and people are yelling dollar bull. I think they need to have a better perspective. From our point of view, both the S&P and the dollar look very similar when you look at very long-term momentum charts. I suspect they will both turn together downside. For the dollar index, which is at 102, it better not drop to 99 or lower during the coming year. Now, that's to say, don't sneeze. The S&P is at 22, 40, 50 area. Been in the 30s, I think, last week. It better not get down near 2,200, especially not 2,180 level. So we're talking 2 to 3%. It better not sneeze. If it does, I think those two asset categories will then engage the other way, downside, in coincidence with the major trend changes, not in coincidence, but months later, commodities upside and bonds to the downside, or yields to the upside. So I think these four major asset categories are all on the cusp. Two of them most people would recognize as having turned. The other two are on the fence post. Not in our view, but in most people's view, and that's stocks and dollar. So our focus is on those two markets right now. And we've defined our numbers in our reports, and there's not much room for any sneezing whatsoever in those markets this coming year. Otherwise, we have a four-asset category trend change.
All right, Michael, just briefly with a little more than a minute left, with respect to the T-bond, you said you sort of expected a counter-trend rally.
Mm-hmm.
I guess as the equity markets decline, you expect money to flow into the T-bonds, probably into gold as well, before the T-bonds resumes their decline. Do you still seeing it that way, and you see gold then as continuing with an uptrend, though?
Yeah, I think this is a linkage that is temporary, but I see a very strong linkage between the T-bonds to the downside recently and gold back to the downside, not a bear trend, but to a sharp pullback. In the case of bonds, it started a bear trend. But it looks like bonds are due for a very sharp, short-term counter-trend rally. I call it counter-trend because the annual momentum trend of bonds is now down. So any rally you get is a trading rally, but, those things happen. Where you get a rally that's opposite the real direction. But I think if you look what's happened to the S&P the last week or so. We dropped about 40 points from high to low. Well, what did the T-bonds do? They rallied about 3 points, and I think there's more to come. And gold has rallied $40 during that same time. So, yes, I do think the T-bond rally is somewhat indicative of positive euro, positive gold, and negative S&P. And that's on the short-term basis.
So for the long term, let's say by the end of this year, you would predict, correct me if I'm wrong, we'll probably see lower bond prices, lower equity prices, higher commodity prices, higher precious metals prices, and a weaker dollar, I guess.
Correct. That's our assessment.
That's what we should be looking forward to. And what I really appreciate about your work, Michael, on an ongoing basis, is that it helps me keep my feet on the ground and understand where I should be in the markets. You've been very reliable, very helpful. And for my listeners, it's olivermsa.com, olivermsa.com to learn more about Michael's work and to sign up for his work. If you're an investor of any size, a significant size, you may want to consider signing up for his work because he has been incredibly helpful to me and I think to many of you. So thank you very much, Michael, for being with us, and Happy New Year to you. We'll look forward to talking to you next week.
Your audience. Thank you very much.
All right.